Avoid these 3 investing mistakes. Investing is one of the best paths to building long-term wealth. It's a way to make your money work for you, to secure your future, and to achieve financial independence. But let's be honest, while many dream of successful investments, diving into the world of investing can be intimidating, especially for beginners. If you're new to this journey, you might have already encountered a swirl of conflicting advice or felt tempted to make decisions based on fear, excitement, or trends. The good news is that making mistakes is normal. What matters most is learning from them and staying motivated to grow. In this video, we'll tackle 3 common investing mistakes that trip up beginner investors and, more importantly, share how you can avoid them. By the end, you'll have greater clarity, the confidence to take charge of your investments, and the tools to make more thoughtful decisions. Let's get started. Do you ever catch yourself scrolling through financial news or social media, seeing a trending stock or hot crypto that everyone is talking about? Suddenly, it seems like everyone is making massive profits, and you feel the pressure to jump in before it's too late. This phenomenon is called chasing trends, and it's one of the most common pitfalls for new investors. It's easy to see why this happens. Markets are full of hype, and it can feel like you're missing out if you don't act immediately. But here's the problem. Following trends often leads to impulsive, short-sighted choices. You make decisions based on fear of missing out, FOMO, rather than aligning with your personal financial goals or risk tolerance. Let me give you an example. Remember the popular cryptocurrency boom? Sure, some people made quick profits, but many jumped in without understanding the risks, and they lost significant portions of their savings when markets cooled off. The key to avoiding this mistake is simple. Stick to a plan. Start with clarity about your financial goals. Are you investing for retirement? Buying a house? Achieving financial freedom? Knowing your why will help you decide on your how. Create a plan that matches your goals, timeline, and risk tolerance, and hold yourself accountable to it. There will always be noise and trends in the market, but your plan, not the hype, should guide your decisions. Staying patient and disciplined is the foundation of successful investing. Let's tackle another common trap, trying to time the market. This mistake comes from the belief that you can predict when stock prices will hit their lowest point to buy or their highest point to sell. On paper, it sounds simple, buy low and sell high, right? But in reality, it's nearly impossible to predict how the market will move, even for seasoned professionals. When beginner investors try to time the market, they often end up doing the opposite of what they intend. How? Well, emotions play a huge role. Imagine this. The market plunges and panic sets in. You feel like selling now before your losses get worse. Or on the flip side, when the market is booming, optimism takes over, and you buy because you don't want to miss out. Here's a real-life example. During major market downturns like the 2008 financial crisis or the COVID-19 market crash in 2020, many investors pulled their money out of the market in fear. A lot of them missed out on the massive recoveries that followed. Long-term investors who stayed the course, however, watched their portfolios bounce back stronger over time. So how do you avoid this mistake? Stop focusing on timing and start focusing on time itself. Long-term investing is a proven successful strategy. Instead of stressing about buying at the absolute perfect moment, consider entering the market steadily using a strategy called dollar-cost averaging. Dollar-cost averaging means investing the same amount of money at regular intervals, like monthly or quarterly, no matter what the market is doing. This approach lowers the risk of making decisions based on short-term volatility and helps you stay consistent and committed to your financial goals. The market's ups and downs are normal. By sticking to a long-term strategy, you step away from the noise and embrace the bigger picture. Remember, it's time in the market, not timing the market, that builds wealth. Now let's talk about a mistake that can feel counterintuitive, putting all your eggs in one basket. Many new investors choose a single stock or type of investment, believing that if it performs well, it'll be enough to grow their portfolio quickly. This is known as ignoring diversification, and it's a risky gamble. Here's why. Every investment carries some level of risk. It could be market downturns, industry-specific challenges, or even regulatory changes. If all your money is tied to one investment, and that investment fails, your portfolio takes a huge hit. Think of diversification as a way to protect yourself. By spreading your investments across different types of assets, like stocks, bonds, ETFs, or even real estate, you lower your overall risk. Diversified portfolios tend to be more stable because when one investment underperforms, others might do well, balancing out your returns. To illustrate, imagine you invested all your money in tech stocks just before a sudden downturn in the tech industry. If you diversified across stocks in different industries, such as healthcare, utilities, or consumer goods, or added other asset classes like bonds, your losses would have been cushioned. So how do you diversify as a beginner? Start small but broad. Many beginner investors find ETFs, exchange-traded funds, an excellent option because they offer instant diversification by including multiple companies or sectors in one package. Additionally, research and understand asset classes so you can balance your portfolio according to your risk tolerance and goals. The goal of diversification isn't necessarily to maximize returns right away. It's to build a stable and resilient portfolio that can weather the ups and downs of the market. We've covered a lot in this video, so let's quickly recap the 3 common investing mistakes and their solutions. Chasing trends instead of following a plan. Remember, the key is to create a plan tailored to your goals and stick to it. Trends will come and go, but your discipline and vision are what truly matter. Trying to time the market. Stop worrying about perfect timing. Instead, focus on long-term strategies like dollar-cost averaging and staying consistent in the market. Ignoring diversification. Build a broad portfolio that balances risk and reward so your investments can thrive, even when certain areas underperform. Here's some final encouragement. Every investor makes mistakes. It's part of the journey. The fact that you're here, learning and growing, means you're already ahead of many people who never take the time to understand investing principles. Celebrate your progress, no matter how small. Investing may seem daunting at first, but remember, it's a skill you can develop. The more you stick to proven strategies, the more confident you'll become. Your future self will thank you for the steps you take today. If you found this helpful, be sure to subscribe for more investing tips and share your thoughts in the comments. What are some challenges you faced as a new investor? Let's build a supportive community here to grow and succeed together. Investing is a journey, not a sprint, so take it one step at a time. Every step forward brings you closer to your financial goals. Keep going, you've got this.